All right, let's dive right in. But first, the really important stuff. Everything you're about to hear is for educational purposes only. This is not, and I repeat, not financial advice. So please always do your own research. So today, we're going to break down a protocol with a claim that sounds, well, almost unbelievable. It's called PLAZM. And we're talking about a system that has already spent nearly $100,000 of its own earnings to buy its own token. And now, thanks to a huge new upgrade, it might just be the first protocol of its kind that never, ever needs another new user to survive. So here's how we're going to tackle this. First, we'll talk about that $100,000 benevolent whale. Then, we'll get into the big problem in DeFi that PLAZM was built to fix. After that, we'll see how its perpetual engine actually works, and the secret sauce that rewards patience. Then, the main event, the buy and grow upgrade. And finally, we'll look at the hard data and the protocol's long-term vision. Okay, so let's get right into that hook. I mean, how on earth does a protocol become its own biggest fan, its own biggest buyer day in and day out? It all starts with this number. We're just shy of $100,000. That's how much real money the protocol has already spent buying its own token off the open market, only to burn it forever. And get this isn't money from new users flooding in. No, this is real yield, cold, hard cash earned from trading fees across the crypto space. It's kind of like having a benevolent whale in the market who's already bought $100,000 worth of PLAZM and then just throw away the private keys. And all of this buying power, it comes from the protocol's own treasury, which, by the way, is sitting at an all-time high of over $400,000. It's a vault packed with over 210 ETH and more than 10,000 little income-generating machines that we're going to talk about in a minute. But, before we get into the how, we really need to understand the why. Why was this thing even built this way? What's the fundamental problem that so many DeFi projects have that PLAZM is trying to solve? Well, look, most crypto projects run on what you could call an inflationary engine. They literally print new tokens out of thin air to pay rewards. And what does that do? It creates constant, never-ending sell pressure. The whole system becomes totally dependent on a steady stream of new money just to keep the price from collapsing. The moment that new money stops, the engine sputters and dies. PLAZM flips that on its head. It uses a real yield engine. It doesn't print rewards, it earns them. It earns real fees from real market activity, and then it uses that cash to support its own token. The treasury isn't being drained, it's generating an income. And this idea of an active treasury, that's the absolute key difference when you look at where PLAZM came from. See, it's a fork of a well-known code base called Titan X, which has this massive $7 million buy and burn pool. But here's the catch. That $7 million just sits there. It's completely idle, earning absolutely zero yield. PLAZM took that same powerful concept and made one critical upgrade. It puts its treasury to work. If PLAZM had that same $7 million treasury, its engine would be cranking out around $7,000 a day in automated buy pressure. That's the difference between a checking account and a high-performing investment portfolio. One just sits there. The other is always working for you. So yeah, this isn't just some theory on a white paper. This engine is humming along right now, every single day. So let's break down exactly how this perpetual loop actually functions. It's a really simple 5-step loop. Step 1, you decide to enter and you make a contribution. And this is super important. 100% of your contribution goes straight into the treasury. Not to developers, not to a marketing wallet, all of it goes to work. Step 2, the treasury takes that money and buys these income-generating assets called bonds. Just think of them as tiny shares in a big portfolio that earns trading fees from all over DeFi. Step 3, those bonds do their job and earn real fees in real dollars. Step 4, every 10 minutes, like clockwork, that yield is automatically deployed to buy PLAZM right off the market. And finally, step 5, the loop repeats and gets stronger every time. More bonds mean more yield, which means more buying. It's a cycle that just feeds itself. And here's a perfect real-world example of that direct impact. Just recently, a single user made a contribution of just under 7 ETH. That one action, boom, instantly purchased 314 brand new bonds for the treasury, permanently boosting its earning power for the future. You see, every dollar goes directly into making the engine bigger and stronger. Okay, so we've got this self-sustaining engine. That's great. But how does the protocol reward you, the user? Well, this is where it gets really, really clever. It uses a special mechanic that rewards long-term conviction exponentially. The system is called T-squared or time squared. And instead of giving you rewards based on how long you stake, it rewards you by the square of that time. Just look at this chart. If you stake for 30 days, you get 900 share units. Makes sense. But if you stake for 77 days, that's about 2.5 times longer. You don't get 2.5 times the shares. Oh no, you get almost 6,000 shares. That's a 6.6 times increase. It's a massive incentive to stick around for the long haul, and it creates this huge advantage for people who are patient. And check out what happens when you apply that power over multiple staking cycles. Let's say your break-even price was 29 cents on your first stake, but your fourth cycle of simply restaking your earnings, thanks to that exponential growth in your shares, your break-even price has plummeted to less than 1/10 of a penny. It just creates this incredible safety net for long-term holders. And that brings us to, without a doubt, the single most important upgrade to this protocol since day one. This is the change that takes the system from being merely sustainable to being fully self-compounding. It's called buy and grow. So the protocol's yield used to be split into 2 different directions. Now it's split into 3. About 65% of the yield still goes to buy and burn, which permanently shrinks the token supply. About 10% goes to buy and build, which adds a little liquidity. And now, here's the game changer, about 18 to 20% of the yield now goes to buy and grow. And what does this do? It takes the yield and uses it to buy more bonds for the treasury. The engine is literally feeding itself to get bigger. And if you take away only one thing from this whole explainer, let it be this. The treasury is now buying, on average, 4 new bonds every single day, using nothing but its own earnings. No new users are required, no new contributions are needed. The treasury is now officially growing itself, forever. Now, you might be wondering, wait, why reduce the part that adds to liquidity? And the answer is this concept called active liquidity. See, instead of building this giant, static wall of cash, the liquidity pool, the protocol figured out it was way more effective to invest in a smaller but constantly attacking offensive weapon. And that weapon is the $1,000+ of automated buying that happens every single day. It acts as a much more dynamic and effective floor against any potential selling. So we've gone through all the theory, all the mechanics. Now let's look at the hard proof. What does the data actually say after 154 days of this engine running? And where's this all going? All right, let's do a quick data blitz. The vault, the core treasury that backs this entire protocol, is at an all-time high. We're talking over 210 ETH, which translates to more than $416,000 in real, hard, yield-generating assets. Next up, the buy and burn function. It has already permanently erased 1.82 million tokens from existence. That's 21% of the total supply, just gone, forever. Okay, and this is where it gets really, really wild. Look at the upcoming calendar for token releases. In just a few days, on day 158 and 159, the protocol is scheduled to release literally zero, new tokens into circulation. The day after that, just 3. And all the while, that automated buy pressure keeps chugging along at over $1,000 a day. On those 0 release days, the buy-to-sell pressure ratio is, well, it's literally infinite. So, this all leads to the end game. What's the ultimate vision here? It's for long-term believers to build up a significant stake in the network, say 1% ownership. At that point, the protocol's own internal buying pressure is so consistent and so powerful that a whole community of these holders could, in theory, take profits every single day, and the automated buy-in would just soak it all up. And the most crucial part, all of this heavy lifting, all this infrastructure is being built right now, at the bottom of the market when fear is at its peak. Just imagine what happens when the market eventually turns around, and the value of all those treasury assets and the yield they produce starts to multiply. And this all comes back to the core philosophy of the whole project. The founder has famously said, "We are unfundable." And that's not a sign of weakness. It's a statement of strength. It means that everything, every single transaction, every dollar of yield, every buy, every burn, is completely and utterly transparent and verifiable right on the blockchain. There are no venture capitalists, no backroom deals, because there's simply nowhere to hide them. So, as we wrap up, I just want to say it one more time, this is a very high-risk space. The value of crypto can be incredibly volatile. It can go down just as easily as it can go up. You should never, ever invest more than you are truly willing to lose. This has been a purely educational breakdown of how this specific protocol works. So, that's PLAZM.
Day 154, $99,885 in real yield deployed, just $115 away from six figures. 10,217 bonds generating over $1,000 a day in buying pressure. 210 ETH in the vault, an all-time high. 1.82 million tokens burned. That's 21% of the total supply, destroyed forever. And now, a treasury that grows itself. 4 new bonds every single day from yield alone. No new users required. The buy and burn runs every 10 minutes. The loop never stops. The bonds never stop earning. The burns never stop destroying. And the treasury never stops growing. That's not a promise. That's just the math. On-chain, transparent, verifiable, unfundable. Day 154. And the engine is just getting started.